Welcome back to Primary Source China Investment. This week we're on show V4, and Peng Guo and I thought we'd talk a little bit about risk management, asset allocation, because we spend so much time talking about product, and people are obsessed with product. But if you look, the greatest amount of return comes from asset allocation. And there's a phenomenon in China that's a little bit weird. Generally speaking, when we talk about taking on more risk, we have the expectation of more return. But in China, that's not always the case. And higher levels of risk have not rewarded investors with higher levels of returns. And we can see that through a very simple chart. We're going to put that chart up. And this chart has three portfolios. As you can see, the red line here is the most volatile, right? It goes up a lot, it goes down a lot. But we all end up in the same place with these three portfolios. And this is 8 years we're looking at. So it's a medium term chart. The high volatility portfolio, that red line, that's 100% K-Web. So that's the tech companies that we've been talking about. And some are listed in Hong Kong, some are listed in the US, they've been migrating. But what's been constant over time for that product is high volatility. Contrast that with the blue line. That is 60% ASHR and 40% CBON. Viewers know CBON is the China fixed income and ASHR is the CSI 300, those A shares. You can see that that has much lower volatility. And if you look at the performance summary, you look at the standard deviation and you look at the average return, the CAGR, CAGR, you see portfolio one, that 60-40 portfolio, has a 1.97% return annualized for 8 years. Not great, but it also has the lowest standard deviation. So that's the measure of volatility. The third portfolio there is ASHR. And you can see over 8 years, it performs a lot like that 60-40. However, it does have higher volatility. So we'll get into these numbers a little bit more, but Peng Guo, what's your thoughts when we lay that out for our viewers?
Firstly, in my personal opinion, whoever talk about high risk, high return, that really means high risk, high loss. That's for sure, sooner or later. Yeah. Secondly is, you are totally right. If you build like the bond and equity portfolio, you will see the Sharpe ratio get changed with a different percentage. So it's pretty clear. Even like in the uptrend of each index, the volatility is still high, and most likely 40% stock and 60% of the bond. Vice versa, it's still like the rule of thumb. It works and could get a better Sharpe ratio. It depends on the situation.
Yeah, I think for investors that are just allocating to China, there's just no way you're going to pick the peaks and valleys of this K-Web, for example. And people could say, well, you know, in the best year, it made 70%. But the reality is you're not going to get that as an investor. There's no way you're going to pick the bottom and pick the top. You can't guess twice and be right twice. So chances are you're going to pick the top and sell out at the bottom. So your worst year ever is going to be down 48%, which, you know, we just witnessed in 2022. So, you know, those are the kind of things that high flying, you know, stocks or ETFs or themes are going to lead investors to. So you can blunt all of that with what you said, fixed income. So what is that magical fixed income? So for C-bond, it's low volatility, low return. It basically tracks the high grade fixed income on the mainland in renminbi. Remember, you're going to go in US dollar and then convert to renminbi. So you're going to hold renminbi. And we've talked about this in the past, right, Peng Guo? We have volatility, dollar, renminbi. So investors are exposed to two types of risk there, right?
That's right. So, now, why you allocate to China, that's definitely you allocate to the currency. Yeah, that's no doubt. So it's also kind of like the strategies blended in the portfolio or asset allocation. Because China right now really have different business cycle, different interest rate cycle with the United States. Diversification could bring the benefit.
Right. And what we've seen over the past, let's look at, again, we're looking at 8 years here. We've seen some renminbi appreciation, some renminbi depreciation, and all around, because it is, the basket does include the dollar. So you're not going to deviate too far from the dollar. And you're going to get probably, currently, I think the yield is 2.7 for the CBOM. I can check that. But generally speaking, you're going to get that fixed income return and a little bit of volatility around that. But what that does is it really blunts the volatility of the equity side. So if you look at the comparison between 60% ASHR, 40% C-bond, and then just ASHR, that's portfolio 1 and portfolio 3, you'll see the standard deviation is much lower and the return is actually much higher. So this is the definition of a free lunch. You are getting a higher level of return for a lower level of risk. This is the nirvana of investing. This is the promised land, if you will, for investors. You're getting higher level of return for lower level of risk. And why investors don't do this all day, every day is really befuddling to me. If you're allocating to China, you have to have an allocation to fixed income.
Yeah, that's definitely a free lunch. And we also just do some quick screen for the entire China A-shares equity market. So we see like in this market right now, they have much more ETFs, probably including money market, is probably almost 1,000 ETFs. But after fill my screen criteria, is get exclude the money market. It was down to 176. And then if you consolidate the 176 ETF, it will become almost less than 20 indices. So it's really the allocation should start from the index level and then find out the related product. Obviously, good index will bring a better return.
Yeah, I think we've established, if it's not just ETF, you also have thousands of products that exist out there. So, the ETF business is just still ramping up, probably a long roadway in China. On the mainland, there's plenty of opportunity for ETF, but it's not really a product problem. And I've been saying this for more than a decade. China doesn't have a product problem. It does have an asset allocation problem. And this is a very simple way to address that asset allocation. If you're allocating to China, you want to hold equity. You also want to hold a chunk of fixed income because it's going to decrease your volatility and it's not going to affect your returns. I think that's the simplest message we can tell people.
Absolutely. Yeah, that's absolutely right. Mm.
Yeah. Well, let's hope people listen. So with that, we're going to leave it with show V4. We're going to put all the charts up there so everybody can see it. With that, have a good weekend, and we'll see you next week.
Thank you.